But if you're purchasing business insurance as a business owner, to some degree home insurance, and certainly church insurance, charitable organization insurance, even though insurance companies may use the same terms, the wordings are all different. And the differences are in the details. I'll give you an example. Insurance company A may be covering you for general liability for $2 million and charge $500 a year. Insurance company B, $2 million general liability, charging you $1,000 a year. Well, hey, you're a good trustee of your charitable property. We go with company A. They're cheaper. We just save $500 we can use for ministry. But if you'd asked a few other questions, say for example, company A, what do you cover? When you say you cover bodily injury, what does that mean? And they say, well, that means death, physical injury, disease. And then you ask company B, what do you cover? Well, we cover death, physical injury, disease, mental anguish, mental injury, humiliation, harassment, discrimination, and abuse. They're charging $500 more. Now, as a trustee who's purchasing insurance on behalf of other trustees, board members, members of the church, does that not change the equation hugely? It's a different product. So, unfortunately, I wish I could be here to tell you it was simpler, but the fact is that in some kinds of insurance, differences really are in the details. And that's why it's good to ask lots of questions. And certainly as a brokerage, it's always been our mandate to provide a lot of good information, and we love to make comparisons because that's where our product shines. General liability is an occurrence form coverage. This is a really interesting thing to think about. What this means is that the policy that is in place at the time that an accident takes place is the policy that responds to that accident. I'll give you an example. Auto insurance, homeowners insurance, church insurance, business insurance. The liability in all of these policies is occurrence. What that means is you go to the policy that's covering you during the time frame when the accident took place. So if you have a car accident this week, you go to your current insurance company. What happens though, there's a statute of limitations of 2 years. And let's say almost 2 years ago, you got into a car accident, didn't seem like a big deal. Suddenly, days before 2 years are up, you get a liability suit from the other party that you were involved in the accident suing you. Now, it might be the same insurance company you have now, but there's chances it could be a different company. You don't go to your present insurer. You go to the insurer that was covering you at the time of the occurrence. And this has really important implications because if you think about abuse claims, what's the nature of abuse claims? Do they get reported right away? They can, but mostly they don't. They come up years later. In fact, what the courts do is they suspend the statute of limitations. They say, yeah, it's usually 2 years, but these were victims of abuse as children. How could they know? They didn't come forward. They didn't even know the extent of what happened to them. So what the courts say is, at the point that they discover their abuse through counseling, psychotherapy into adulthood, that's when the clock starts running. And it's an ambiguous guideline, but it's how the courts do it, and I think it's just. But what it means is you've got liability suits that are coming up 20, 30, 40, 50 years after the fact. They're not covered by the current policy. If they're going to be covered, they're covered by the policy that you had in place at the time. And the insurance company is going to be obligated to pay for it. But it shows a couple of things. You want to make sure that you have good limits because that liability suit that may come forward may not be for a while yet. And it also points to the importance of keeping your policy documentation on file in perpetuity. Probably 20 years ago, less than 5%, just a handful of our charities were covering themselves for directors and officers' liability. I would say now the number is about 75% of our churches and charities have directors and officers' liability today. And what does it cover? Well, the general statement is it covers the negligent acts, errors, omissions, misstatements, breaches, or neglect of duty by your directors and officers. Breaches of duty, neglect of duty, this goes back in reference to we were talking about fiduciary duties. Okay. And examples. Well, what's covered under a director's and officer's liability policy? Well, can or should cover wrongful dismissal claims. Other types of employment practices. What happens if somebody sues for employment-related humiliation, harassment, discrimination? Sexual harassment in the Christian workplace is not unknown. I can tell you that for certain. Discriminatory practices. As faith-based organizations come increasingly in conflict with other parties in our society, we're seeing suits based on discrimination for use of facilities, beliefs that we have, people that are officiating services and ceremonies. It's becoming an increasing issue. Discipline proceedings. Your board is asked to maybe review somebody's membership. They're not living a lifestyle that's in accordance with your statement of faith. You can't have them representing you. Financial mismanagement. A board is negligent in overseeing a building project, overseeing investment of money, overseeing use of donor funds, not remitting source deductions properly to Revenue Canada. You may or may not realize this, but if you had, say, even unintentionally under-remitted source deductions for a period of years, and CRA comes back, discovers it on audit, suddenly the number they come back with, including fines and penalties for everybody, is a big number. They can choose to go against the individual, or they could choose to go against the directors and officers. Breaches of contract. There are some contracts where a party that you're working with, maybe a joint ministry partner, somebody you're entered into a construction project with, a variety of examples, they allege you breached the contract and caused them economic damages, and they're holding your board of directors responsible for their financial loss. Okay, so these are examples. I'm going to give you a flavor of what a director's and officer's liability policy is intended to cover. Again, it's a more recent form of insurance based on recent trends. The first three exclusions in a director's and officer's liability policy are bodily injury, property damage, and personal injury. It's not meant to overlap with the general liability policy. It's meant to complement it. This is a really important point. You remember I talked about general liability and I said it covers the kinds of things that can happen with the highest potential for damage awards, the highest numbers, the highest quantum of damages, multi-million-dollar lawsuits. Directors and officers liability covers situations that have a moderate amount of awards. The highest case awarded in court or that I'm aware of in a settlement, and it's kind of tricky because some things have sort of publication bans or done in confidence, but it's still shy of $1 million. Because they're based on financial damages. They're not based on bodily injuries, fatalities, pain and suffering. They're based on an actual economic loss. So it's quite common for an organization to carry a much higher general liability limit, including umbrella coverage, than it is to carry directors and officers liability.